There is a building in Washington, D.C. that has more control over your financial life than Congress, more than the president, more than your boss, more than your landlord. And there's a very good chance nobody has ever mentioned it to you by name. It's called the Federal Reserve. And right now, in 2026, it is deciding whether your rent goes up or down, whether your credit card interest rate stays brutal or gets worse, whether companies start hiring or start firing, whether the economy grows or crashes, one building, 12 people in a room, your entire financial future on the table. Here's what makes me actually angry about this. You spent 12 years in school, maybe more. You learned the quadratic formula. You learned the causes of World War I. You learned how to dissect a frog. Nobody sat you down and said, hey, there is an institution that was created in secret, partially controlled by private banks, and it sets the price of money itself. And that price affects every single bill you will ever pay for the rest of your life. That's not an accident. That's a choice. But here's what they should have told you. By the end of this, you'll know exactly what the Federal Reserve actually is, who created it and why, who controls it right now, and most importantly, how every single decision they make lands directly in your wallet. We're going to talk about interest rates, inflation, your rent, your debt, and your job security, all connected, all controlled by one system. This is going to change how you read the news for the rest of your life. Let's get into it. Let's start at the beginning, because the Fed didn't just appear out of nowhere. Go back to 1907. America is in financial chaos. There's no central bank, no safety net. Banks are making risky bets. And when those bets go bad, people run to pull their money out all at once, every bank at the same time. This is called a bank run. And in 1907, it nearly destroyed the entire US economy. Businesses collapsed. People lost everything overnight. There was no system to stop the bleeding. Congress looked at this and said, we need a fix. But here's where it gets complicated, and here's where the outrage starts building. The people who got called in to design that fix, they were bankers, specifically some of the most powerful private bankers in America at the time. JP Morgan's people, Rockefeller-linked people, the exact same class of people who had been causing instability in the first place. In 1910, a group of powerful financiers met in secret at a place called Jekyll Island, Georgia. They disguised themselves, they traveled under fake names, they designed the blueprint for what would become the Federal Reserve. Let me be clear about what that means. The system that was supposed to protect everyday Americans from bank failures was largely designed, in secret, by the banks themselves. That's not a conspiracy theory, that's documented history. The Jekyll Island meeting is in the congressional record. Participants wrote about it openly after the fact. Congress passed the Federal Reserve Act in 1913. President Woodrow Wilson signed it. And just like that, the Federal Reserve was born. Okay, so the Fed exists, but who runs it in 2026? This is where most people get confused, and that confusion is convenient for the people in charge. Here's the structure. Stay with me because this actually matters. Layer 1, the Board of Governors, 7 people, based in Washington, D.C., appointed by the President, confirmed by the Senate. They serve 14-year terms. Let me say that again. 14 years. Your vote changes the president every 4 years. But the people actually running monetary policy can be in that room for 14 years regardless of who you elect. That's not a bug in the system. That is the system by design. The idea is to keep the Fed insulated from political pressure. Whether you think that's good or bad, you should at least know it's true. Layer 2, the FOMC. This stands for the Federal Open Market Committee. These are the 12 people who actually set interest rates. Let me tell you who those 12 people are. 7 of them are the Board of Governors, fine, federal appointees, but 5 of them are presidents of regional Federal Reserve banks, and those regional bank presidents are not appointed by the President of the United States. They are not confirmed by the Senate. They are selected by the boards of those regional banks. And who sits on those regional bank boards? Private banks, commercial banks. The same banks that borrow money from the Fed, the same banks that have a direct financial interest in what interest rate gets set. Now, there are rules. There are conflicts of interest policies. The system isn't as simple as banks just set their own rates. That would be too obvious. But the structural reality is this. 5 of the 12 people who set the price of money in America hold seats that trace back to private banking interests. That's not conspiracy. That's the Federal Reserve's own published governance documents. The Federal Reserve calls itself independent. It answers to Congress and reports to Congress, but it does not take orders from Congress on day-to-day decisions. The idea is that monetary policy needs to be removed from politics. You can respect the theory and still ask hard questions about the structure. Here's where we connect the Fed directly to your daily life. This is the part they really should have taught you. The Fed's most powerful tool is something called the federal funds rate. Let me break that down. The federal funds rate is the interest rate at which banks lend money to each other overnight. Banks constantly borrow from each other to meet their daily requirements. The Fed sets the target for what that rate should be. When that rate goes up, everything gets more expensive to borrow. Your credit card APR goes up, your car loan rate goes up, your student loan rate goes up if it's variable, mortgages get more expensive, business loans get more expensive, which means companies might hire less or lay people off. When that rate goes down, borrowing gets cheaper. You've seen this play out in real time. Alex is 22, first real job, first apartment. She's looking at her credit card statement right now. That 24% APR she's paying, part of why that number exists is because of decisions made in that building in Washington. The Fed raised rates aggressively in 2022 and 2023 to fight inflation. Credit card rates followed. And in 2026, those rates have not fully come back down. Alex didn't cause inflation. Alex didn't vote for high rates, but Alex is paying for it. Jordan is 17, working a part-time job, trying to save up. He keeps hearing that interest rates affect savings accounts too. He's right. When the Fed raises rates, savings account yields can go up, which sounds good. And for people with money already saved, it is good. But for Jordan, who's trying to afford his first car, his first place, the higher borrowing costs hit him first and hardest. The savings rate benefit takes time and money to feel. The loan rate pain is immediate. This is important. High interest rates are not universally bad. They're not universally good. They are a trade-off, and the question is always who bears the cost and who gets the benefit. The people who own a lot of assets, who have a lot of savings, who own property, they tend to benefit from high rates. The people who are just starting out, who need to borrow to build a life, who rent instead of own, they tend to get crushed. That's not an accident either. That's what the system produces. Let's talk about the other half of what the Fed does. Because it's not just about interest rates, it's about inflation. The Fed has two official jobs. This is called the dual mandate: price stability, meaning keep inflation around 2% per year, and maximum employment, meaning try to keep unemployment low. Those two goals are often in direct conflict. That tension is the thing that drives every major economic news story you've seen in your lifetime. Here's why they conflict. When unemployment is very low, meaning almost everyone who wants a job has one, workers have power, they can demand higher wages. Companies that want to attract workers have to pay more. Those higher labor costs get passed on as higher prices. Prices rise, that's inflation. So the Fed sees low unemployment and sometimes thinks, we need to slow this down. How do you slow it down? You raise interest rates, borrowing gets expensive, companies invest less, some companies start laying people off, unemployment ticks up, wage pressure eases, inflation cools. Read that again carefully. The Federal Reserve deliberately uses unemployment as a tool to fight inflation. When the Fed raises rates to cool the economy, they are, by design, creating conditions where some people will lose their jobs. That is not a side effect. That is the mechanism. I want you to sit with that for a second. Someone losing their job in 2023, 2024, 2025, in tech layoffs, in retail cuts, in construction slowdowns. Part of that story is the Fed's rate policy, not all of it. The economy is complicated, but part of it. Now let's talk about rent, because this one really burns. You'd think that if the Fed raises rates and makes mortgages more expensive, housing would get cheaper. More expensive to buy means fewer buyers, means prices drop, right? Except here's what actually happened. Homeowners who bought or refinanced when rates were near zero, like 2020, 2021, locked in 2.5%, 3% mortgages. They're not selling. Why would they? If they sell, they have to buy something new at 6%, 7%, even higher rates. They're staying put. So the housing supply dried up, fewer homes for sale. Demand didn't disappear because people still need to live somewhere. Prices stayed high. And the people who couldn't buy, they kept renting. More renters chasing the same rental units. Rents went up. The people caught in the middle, first-time buyers, young renters, people who were not lucky enough to have bought before rates exploded. Alex is paying $500 a month for a one-bedroom in a mid-sized city. That's not because Alex is bad with money. That's because a set of rate decisions made in Washington, combined with a housing supply problem that's been building for decades, created a market where that's just what it costs. This is genuine, specific, documented outrage. Young people did not cause the inflation of 2021 and 2022. Young people did not benefit from the asset appreciation that came with low rates in 2019 and 2020, and young people are now paying, through high rents, high credit card rates, brutal loan costs, the price of cooling an economy they had almost no role in overheating. So where does this leave you? Here's what I need you to walk away knowing. The Federal Reserve is not a villain, it's not a conspiracy. It is a real institution with real power, doing a genuinely complicated job, and it was built with structural compromises that favor people who already have money and assets over people who are just starting out. Understanding that is not cynicism. Understanding that is clarity. Here's the one thing you can do today: go to federalreserve.gov, find the FOMC schedule. It's public, it's free. They announce it a year in advance. Those are the dates when interest rate decisions get made. Mark them. When a decision is announced, read one article about it, not to become an economist, just to understand, did rates go up, down, or stay the same? And then ask yourself, what does that mean for my credit card, my savings account, my job market? That question alone, just asking it, puts you ahead of most adults in this country. The system wasn't designed with you in mind, that's the honest truth, but you can learn it, track it, and make decisions inside it that protect you. That's what this channel is for. Not to make you angry and leave you there, to make you angry and then give you a map. If this hit different, follow us, because next time we're going into exactly how to use high interest rate environments to actually build savings when you're starting from zero. The flip side of everything we just talked about, you now know more about the Federal Reserve than most people twice your age. Use it,